Greetings. I'm Nik Schuurmans, president and founder of Pure Portfolios. You are looking for an advisor. It's a confusing landscape. I empathize. There's a lot of misinformation out there. There's a whole array of potential advisor fits. And what I hope to do in this video series is to educate you on the landscape, the pros and cons for the various types of advisors. I think there's a consumer belief that all advisors are the same. I believe that's a dangerous conclusion in 2022. So I'm going to share my screen. I'm going to keep my comments brief and concise, and hopefully this helps you have a framework for choosing an advisor. So just a caveat before I get started. This is for people that want a human component in their advice. You want to work with a human advisor on some level. Okay, so this is not for the do-it-yourself investor. This is not for the trader. This is not for someone that wants to speculate on their own. This is for someone that wants a long-term partnership with someone that they can trust that has a human component. Okay, and we're going to be looking at low-cost advisors like a Vanguard or a Betterment, a low-cost service, technology-based. It could be just online. And then on the other end, we are going to look at a traditional advisor. So big Wall Street firms, big banks, insurance companies, broker dealers, strip mall advisors, more of the suit and tie, nice office space type of advisor. And then we're going to be looking at how Pure Portfolio stacks up with the low cost advisor and the more traditional advisor. And as you'll see, we've taken the best of both worlds to combine and create a hybrid offering, a lower cost, personalized human experience. So let's get into it. So if you see a check mark, that means the entity has that feature. So this means Vanguard and robo-advisors have low fees. Pure has low fees compared to traditional advisors, a little more than Vanguard, but much less than Wall Street. Wall Street is notoriously expensive, and you might be paying your advisor a 1% fee. That's pretty standard. But you also need to look out for expensive mutual fund expenses, which can add another 0.5% or even 1.5% to your total cost of investing. Total cost of investing is what you pay your advisor plus the cost of owning the assets. So beware of mutual funds. Conversely, Pure Portfolio's fees start at 0.65, so about 0.6%. We'll use Vanguard as an example. Vanguard fees start at 0.35 or about 0.3%. And that is their advisor services program. So we touched on the mutual funds. So mutual funds are historically expensive. Vanguard has really been the pioneer of introducing the index fund, which is a low-cost fund, usually tax efficient, although Vanguard's gotten into some hot water for saddling clients with capital gains over the last couple of years. But in general, Vanguard uses low-cost funds, which is a great thing for investors. On the opposite end, Wall Street firms, big banks usually use active mutual funds, high-cost mutual funds, which can be a drag, not only from a performance standpoint, but from a fee and tax standpoint. So if you're working with a big Wall Street firm, not only are you paying probably 1% or more, but likely you're invested in high-cost mutual funds and your all-in cost of investing is unnecessarily high. Pure Portfolios does not use mutual funds. They're tax inefficient, they're expensive, their performance historically has not been very good. A good part of that poor performance is their outsized fees. So we use low-cost exchange-traded funds or ETFs. They're tax efficient and they're low cost. We also use an individual stock or bond strategy, which there's no ongoing cost to own that. So that's for custom portfolios. And again, a great way to lower the overall cost of investing. We are a big believer that humans drive incentives. Okay, Vanguard has a large client base. They manage $7 trillion in assets. People seek them out. They don't really have salespeople. Pure Portfolios only hires professional investors or professional planners. We don't have sales goals. We don't answer to a board of directors. We are an independent company. Part of why we're able to do this is because we write our own content. I've written a blog every week for the last 6 years. We have a podcast. I do explainer videos. We do our own market commentary. People find us. So our content is designed to educate people to make better decisions, but it's also our voice in a crowded space. And again, people find us through Google. They find us through a blog post. It's a great gateway into Pure Portfolios. Wall Street really hire salespeople. That's kind of the name of the game. If you work with a Wall Street advisor, know that probably greater than 50% of their time is spent on sales related activities. They're in sales meetings with their managers. They're going over what they've closed, what's in their pipeline. They're beating the pavement any means necessary to bring in new clients, because that's how they're paid. That's a big chunk of their compensation. So that's what they're focused on, sales versus client outcomes. So Vanguard is a fiduciary. They've done more to lower the overall cost of investing for the retail investor. They do a great job, a great fit for someone that wants straightforward advice, has a simple plan. Pure Portfolios is a registered investment advisor. We have a legal obligation to act in the best interest of clients. Again, we're an independent company. We answer only to our clients. We get paid only by our clients. We don't sell stuff. We don't use expensive mutual funds. We don't take kickbacks from fund families to use their funds. Our fees are plastered on our website. We believe in transparency and openness. We are an open book. That's not the case for big Wall Street firms. Sometimes they can be a fiduciary, other times not. You need to be very mindful of the incentives that are driving the advice. Humans respond to incentives, okay? And before hiring an advisor or taking them at face value that they are a fiduciary, do your research online. There's Google reviews. You can look at SCC Fines. You can look at your advisor's record for discipline. There's a trove of information out there. Too many times people hire advisors based upon a popular name or what their family's worked with or what a coworker has worked with or just the first advisor that they talk to. Do your due diligence. This is a hugely important decision, and I can't stress that enough. And in 2022, if you're working with a salesperson that's masquerading as an advisor, you are doing it wrong. If your advisor's trying to sell you stuff, if you don't know what you pay for advice, if you can't find your fees, if you don't know how you're invested, if you don't know how much risk that you're taking, if your advisor is slow to get back to you, that is a red flag, and they probably are not a fiduciary. Kind of in that same vein, you want someone that shows a passion for their craft, a growth mindset, someone that wants to take ownership of their profession. So again, we only hire credentialed, certified professionals. And if you have an advisor, ask them about their credentials or lack thereof. And some of the most popular and respected credentials are the CFA, Chartered Financial Analyst, that's more on the investment side, or the CFP, Certified Financial Planner, that's on the planning side. Custom portfolio. So if you have a portfolio over $1 million and you have complexity from a tax standpoint or a concentration standpoint, or you like an individual stock or bond model, if you have a values-based tilt, like you want to invest in energy efficient companies or green energy companies or companies that invest in their communities, we can put a values-based tilt on any portfolio. And that goes for themes too. So if you have a desire to build out a global dividend portfolio, we can put that bent on there. If you like technology companies, we can create a technology-based index. You know, if you go to a lower cost robo-advisor, they're probably not going to build out a custom portfolio for you. And that's not the worst thing, but no, if you have some customization needs, that might not be the best fit. Leader in SCC Fines, Pure Portfolios just completed their first audit. It came back clean. Most Vanguard and other robo-advisors, you know, with a few exceptions, are good actors. Again, they've done more to lower the overall cost for advice. Wall Street, on the other hand, is the most fined industry out there, and it's the same year after year. The reasons for the fines change, but if you look at the history of corporate fines, big banks, Wall Street, brokers, they are the leader in the clubhouse, and it's not even close. So sometimes there's this illusion of comfort because you're working with a firm that's been in business for 50 years. And I think that's really misguided, because if you look at bad acting, the most fined companies, they are the companies that have been around forever, and they're openly working against you. And the fines document that. That's them getting caught. But no, they're throwing millions of dollars every year at lobbyists to protect their profit machine, to protect what they've built, to protect the misaligned incentives and the conflicts of interest. So when someone tells me they work for a big Wall Street firm, my ears perk up, because a lot of times they are oblivious to the predatory nature of a lot of these companies. So there's a lot of talk out there about a certain company that they only do better when their clients do better. And I think that is misguided at best. Many advisors charged a fixed percent. A common fee is 1%. Okay, so let's say you work with an advisor that charges 1% and you have $1 million. Okay, if that portfolio is flat for the year, you'll pay $10,000, 1% times $1 million. Okay, if that portfolio goes up to 1.2 million, multiply it by the same 1%, and that advisor will get $12,000. Conversely, you work with a 1% advisor, your portfolio goes down to $800,000, multiply 800,000 times 1%, that advisor gets $8,000, okay? So while the dollar amount changes depending on the portfolio value, the percent that your advisor charges does not change, okay? So they get paid whether they do a great job, a poor job, or an average job. Pure Portfolios didn't think that was ideal. We wanted to draw a clean line between client outcomes and our compensation. So let's take that same example. Let's say your fee is 0.8% on the same $1 million. So our fees are about 20% lower than the average advisor fee. Okay, 0.8% or 0.8% times $1 million is $8,000 a year. Okay. Let's focus on the downside because that's where the magic happens. Because if your portfolio value goes up, we're going to charge 0.8% and we're going to get a greater dollar amount fee. So that part is very much the same. What's unique is on the downside. So let's take that same example and say we take that $1 million, we have a difficult year, that portfolio is worth 800,000 now. Okay, 800,000. So for the entire next year, instead of charging 0.8, keeping our fee rate the same, we are going to charge 0.6% times 800,000. So not only is the dollar fee that we're going to take going to be lower, but we're actually discounting the fee rate. So 0.6 times 800,000, what is that? $4,800 a year. That's almost cutting your fee in half, and you're benefiting, quote unquote, from the lower portfolio value, but mainly the lower percentage value. That's a huge difference. To my knowledge, as of this recording, we are the only firm in the country that does that. And look, we're a firm believer that humans respond to incentives. We have skin in the game. We sit on the same side of the table as clients. We feel our compensation should be lower if your outcome is poor. It's not a promise of outperforming the S&P or, delivering delusionally high returns. It's not about that. It's about a cleaner alignment of incentives. So we're incentivized to focus on the job that you hire us to do. That's to manage the portfolio, not to go out and sell, not to go out and multiply more assets by 1%. It's to manage the assets prudently. So I talked about our blog. I've been doing that for 6 years. We're increasing our content. And a big part of that is getting people to behave better, getting people to look inward and understand how their personal experiences shape the way that they view money, understanding their cognitive and emotional biases and unpacking those, because we all have them. And if we understand them, the chances of us behaving better and understanding how our behavior can derail our long-term plan, the better probability of a favorable outcome. So we write a lot about investor behavior and behavioral finance, and we want everyone to have a better outcome, even if they're not a pure client. And lastly, our fees are open and transparent. They're right on our website. A lot of the robo-advisors are the exact same. Their fees are right on their website. If you're working with a Wall Street firm or if you're working with a traditional advisor and you don't know what you're paying and it's a mystery and it's not in your statement and you ask for it and you still don't understand, that is a major red flag. Run the other way. That is the sign of trouble. A non-fiduciary advisor. Fees should not be a mystery. It should be open and transparent. Your advisor should be forthright with it. So I know we covered a lot. I'll try to keep this brief. I hope this helps you understand the various landscape between low-cost advisor, higher-cost Wall Street, and traditional advisors, and what we've built at Pure Portfolios, a hybrid, taking the best of a low-cost offering and combining that with the personalized service and partnership that people want in a human advisor. If you have any feedback or questions or the way we work with clients, or you want us to give an opinion on your current advisor, feel free to shoot us a note at insight@pureportfolios.com. Thank you.